Hey everybody, it's Tony Parr with the Parr McKnight Wealth Management Group. As Woody Allen once said, I'm not afraid of dying, I just don't want to be there when it happens. When I read that quote, I thought of volatility in the stock market. Many investors say they don't mind it, but when it actually happens, it becomes very uncomfortable. We all want the big returns that come over the long haul, but it's no fun going through periods of decline like the one we've experienced recently. So my video today is about volatility. Let's start with a historical look at the last 25 years or so. Notice in the lower left-hand corner of the chart, the market is represented by the S&P 500, began in 1996 around 700. A few of us remember the technology stock boom that hit a peak in March of 2000. The market subsequently lost over half of its value and then recovered all of it by 2007. But this time, after losing 50%, one needed a 100% rate of return just to break even. That's called the law of large losses. Then we hit the financial crisis and boom, we went down another 57%. Then stocks went on a hyperbolic ascent, up 400%. The next thing you'll notice is the 34% decline brought on by the pandemic and the lockdowns. In just a few months, stocks recovered, shooting up over 100%, only to see the most recent decline of roughly 20% in the S&P 500. Lots of data, lots of history, but the moral of the story is over that 26-year period, you made 5 times your money. Is that a fluke? No, it's history. What's next? I really don't know, but I continue to believe that owning great companies that pay and grow dividends will work over the long haul. But is now a good time? It's actually a very difficult time. People are just not feeling good right now about what's going on in the world, whether it's divisive politics, inflation, the war in Ukraine, a business slowdown or potential recession, or any other worry of the day. The bottom line is that it's easy to be worried. So what happens to the stock market when a large number of people are worried? Let's look at history again. What you're seeing on this page is the University of Michigan Consumer Confidence Survey results. Basically, it's a study of how people in the USA feel. You'll notice 8 dots below the median and 8 dots above. The median temperature or sentiment is 85. Let's consider that the average temperature of how the country feels in good times and bad over a long period of time. I'll draw your attention to the legend in the upper left-hand corner of the page. This quantifies what has happened in the stock market in the subsequent 12 months after the country is feeling extremely good or feeling crappy. You'll notice that if you average the 12-month forward returns in the times people are feeling good, the blue dots north of the center line, the returns tend to be in the 4 to 5% range on average. But if you invest when people are feeling poorly, anxious, depressed, pessimistic, the forward returns have been much better, exceeding 24% over the next 12 months. So here's 2 obvious things. Nobody knows the future, and predicting the future is a fool's errand. My call to action to you is just to make sure that you have the right mix of assets, stocks, bonds, cash, real estate, and that you're incorporating that accurately into an overall financial plan. I'm always happy to expand the conversation with any one of you. Just give me a call or shoot me an email. We'll make time for you. Thanks for watching today.